For a generation, one golden rule was drilled into millions of investors. Bonds are the safe counterweight to stocks. When the stock market falls, your bonds protect you. It's the logic of the classic 60-40 portfolio, the safe haven that never fails. In 2022, that supposedly immutable rule was blown apart. The safe half collapsed right alongside stocks. The worst year for bonds in over 2 centuries. How is that even possible? To understand it, you first have to understand how a bond's price is really set. You don't need formulas. You need a single idea, and we're going to build it piece by piece. Let's start with what a bond actually is. A bond is a fixed promise of future money. 3 pieces. Only 3. First, the face value. The amount they pay you back at maturity, let's say $1,000. Second, the coupon. A fixed payment every year. At 5% on $1,000, that's $50 a year, every year without fail. Third, the maturity. The time left until the bond comes due. Let's say 10 years. Hold on to one word: fixed. The promise is fixed the day the bond is born and never changes. No matter what happens, $50 a year and $1,000 at the end. If everything is fixed, what moves? The price, and it changes every day. To understand why, meet the other character, the yield the market demands today. Every day the market sets a number, how much return it demands to lend at this maturity. No committee decrees it. It emerges from millions of buyers and sellers. And here is the tension that explains everything. Your coupon was fixed the day it was issued, but what the market demands updates, second by second. Now we can define price. A bond's price is the present value of its cash flows. You take each future payment and bring it back to today, because future money is worth less than money today. You discount each cash flow, you add them up, and that sum is the price. Discounting is one single thing. Divide the payment by 1 plus the yield, raised to the years away. The farther out, the less it's worth today. The full formula is on screen. It's nothing more than that sentence, written concisely. Now comes the other relationship, the heart of the video. Back to our bond. $1,000, fixed coupon of 5%, 10 years. The day it's born. If the market also demands 5%, it's worth exactly $1,000. Your coupon pays precisely what the market asks, and the price is par. But the market moves. Imagine it now demands 6%. New bonds pay $60 a year per thousand, and yours only pays $50. Every year for the 10 it has left, your bond pays $10 less than a freshly issued one. That yearly gap is the differential, the coupon minus what the market demands, times the face value, minus $10 a year for its whole remaining life. And how much is that stream of shortfalls worth today? Like any cash flow, its present value. You bring each of those $10 back to today and add them up. And instead of dividing 10 separate times, the math folds it into a single expression, the annuity factor. It isn't a new magic number. It's that same sum of discounts. With that, the full formula fits on one line, and it's the jewel of the video. The price change is the yearly difference times the annuity factor, and the final price is par plus that change. In one sentence, the most important of the video. The price is par plus or minus the present value of the differential between your fixed coupon and what the market demands. Coupon larger, a premium. Coupon smaller, a discount. Equal par. Let's put numbers on it. The market demands 6%, so the yearly difference is minus $10. The annuity factor at 10 years and 6% is 7.36. Multiply, and you get minus $73.60. The price is $1,000 minus $73.60, $126.40. It trades at a discount. The opposite case is symmetric. If the market demands 4%, the difference is plus $10 a year. The factor is 8.11, and that gives plus $81.11. The price, $1,081.11. It trades at a premium. It's not magic. It is, down to the cent, the present value of what your coupon gains or loses each year versus a new bond. This one idea makes the famous seesaw mechanical. When the market demands more, your differential gets worse and the price falls. When it demands less, your fixed coupon becomes generous and the price rises. Price and yield, always in opposite directions. That's the seesaw. It isn't a separate rule, it's the consequence of discounting the differential. The discounting is the mechanism. The seesaw is what you see. This also explains why a longer maturity bond moves more. The more years it has left, the more differential there is to discount. 10 years of collecting $10 short weigh far more than 2. More maturity, more movement. That's the idea of duration, how much the price reacts. Let's go back to the mystery from the start, because you can solve it yourself now. Why, for a generation, did bonds protect stocks? Because of the same seesaw. In a growth shock, stocks fall because the market expects lower earnings. And at the same time, the central bank lowers rates, so the market demands less yield on bonds. And by the seesaw, their price rises. Just when your stocks are losing, your bonds gain. That's the safety net. And why, in 2022, did it fail? Because that shock wasn't about growth, it was about inflation. Central banks raised rates aggressively, and the market shifted to demanding far more yield on bonds. And what happens to a bond's price when the demanded yield jumps suddenly? It falls. By the same discounting of the differential as before, bonds collapsed, and stocks were falling at the same time. For once, both halves fell together, and the safe haven sank with the ship. But an inflation scare alone doesn't explain a record year. The key is where we came from, rates near zero. With the starting yield, that low duration is at its maximum, so the same rise causes a far bigger fall, and there's almost no coupon to cushion it. That's why both fell together, and it was the worst year for the 60-40 since 1937, and the lesson is evergreen. The sign of the correlation between bonds and stocks depends on which shock is in command. If growth rules, they move in opposite directions and the bond protects. If inflation rules, they can fall together. Same mechanism as always. Only the force in command changes, and that same mechanism multiplied by leverage sits behind some of the biggest blow-ups in financial history. But those are stories for later. Everything hangs on a single idea. The price is par, plus or minus the present value of the differential between your fixed coupon and what the market demands. Out of that comes everything, the seesaw and duration. And here's a seed. Throughout this video, what the market demands has been a single number, but it's different for every maturity. Lending for 2 years isn't the same as lending for 30, and that shape is the next episode. This is educational content, not a buy or sell recommendation. If this clarified things, subscribe to the My Best Wealth channel. We analyze. You decide.